Welcome back to the Pro Ticker Podcast, your Friday morning edition, covering major financial magazine headlines, everyone. If you are trading, investing, or just paying attention to the markets today, you know we are staring down what was set to be an exceptionally volatile Friday. This is January 9th, 2026. And this isn't just a regular trading day, not at all. The market is facing what analysts are calling a critical 1-2 punch. We've got major domestic economic data colliding with a massive, and I mean massive, political legal decision. And as if that's not enough, geopolitical risks are heating up worldwide. Our mission today is to really cut through that noise and figure out how traders are positioning for this potential chaos.
And that tension is, well, it's palpable. It's why for this deep dive, we're pulling key insights from Bloomberg, CNBC, and Yahoo Finance, and they're all highlighting the same extreme stress points.
Right.
The immediate focus, of course, is the $30 trillion U.S. government debt market. A keynote from Zach Griffiths at CreditSights pointed out that the bond market has been stuck in this almost complacent range.
You're talking the 10-year yields, right?
Exactly.
Right.
It's just fluctuating between 4.1% and 4.2%. He argues that period of calm is officially over. Today's the day complacency ends.
Okay, so let's get right to it. Punch one, the long-awaited December jobs report. It's due out at 8:30 a.m. Eastern. Why is this specific report so critical?
Well, because it's the moment the fog lifts. As Bloomberg emphasized, this is the very first reliable, on-time reading we've had on the economy since mid-November.
Because of all the government shutdown delays.
Precisely. The last few weeks of data have been completely disrupted. So this report, this is the truest read on the actual momentum, or maybe the lack of it, in the U.S. labor market.
So what are the expectations? What's the number everyone's looking for?
The consensus is for modest growth. Economists are forecasting a median gain of about 70,000 payrolls.
Which is only a slight bump from November 64,000.
It is. The unemployment rate is projected to dip a little, to 4.5% from 4.6%. CNBC notes the Dow Jones consensus is a bit more optimistic, maybe 73,000 jobs.
But the bigger picture for 2025 has been this modest growth, right? Mostly in safer sectors.
Very much so. Concentrated in healthcare and government. We are still, firmly in what people are calling this no hire, no fire economy.
And what does that no hire, no fire economy really mean for the consumer, for the person on the street?
It creates this huge psychological weight. And this is a key insight from the Yahoo Finance coverage. Yes, employment is steady, but the perceived probability of quickly landing a new job that hit a record low in December, according to a New York Fed survey.
So you might have your job, but you look around and the market just feels frozen.
Exactly. And that anxiety, it feeds directly into a hesitancy to spend, especially on big-ticket items.
And this data, it's the ultimate test for the Federal Reserve. They've already cut rates 3 times. Does a weak number today just guarantee a 4th cut at the January meeting?
That is the high-stakes bet that's driving traders this morning. The result will either cement the idea that the Fed holds steady, or it'll dramatically boost the odds of another cut.
And Mervis Securities put a number on that, didn't they?
They did. They think a really weak number, we're talking roughly flat growth, could lift the probability of a January cut to 50%.
Wow. 50-50.
Yeah, so if you're a risk manager, you have to be pricing that in right now. The market is waiting for the Fed's next move, and this data is the decider.
All right, that's punch 1, the known risk. Now for punch 2, the legal wild card, the Supreme Court tariff ruling.
This is the legal earthquake that could drop at any second today. The court may rule on the legality of President Trump's sweeping tariffs.
And the core legal question here, it has these massive financial implications.
It's all about whether the president exceeded his authority under the 1977 International Emergency Economic Powers Act, or IEPA.
Okay, so for listeners who aren't steeped in legal statutes, can you break down IEPA? Why is it being challenged?
Sure. IEPA is a 1977 law that gives the president broad powers to regulate international economics during a declared national emergency.
So sanctions, freezing assets, things like that.
Historically, yes. The challenge here is fundamental. Does a standard trade imbalance constitute a national emergency that's serious enough to bypass Congress setting tariffs?
That's the tightrope the Supreme Court is walking. And the financial scale here is just enormous. If they rule against the administration, we're talking about, what, $100 billion in government revenue?
$100 billion or more, instantly jeopardized. Yahoo Finance pointed to the Tax Foundation, which estimates a staggering 55% of all duties collected in 2025 came from these legally questionable tariffs.
55%. So if that revenue vanishes.
You have a massive, immediate hole in the budget. and that lands squarely on the U.S. government debt market.
So for an average investor, what does that mean for their bond portfolio?
Well, J.P. Morgan Chase strategists were clear. A ruling against the tariffs would likely rekindle fiscal concerns.
Meaning the market starts worrying about how the government plugs that gap, more borrowing.
Exactly, which risks higher long-term yields and a steepening yield curve.
Let's pause on that. A steepening yield curve, in plain English.
It just means the market is demanding a much higher interest rate to hold long-term U.S. debt, like 10-year or 30-year bonds, compared to short-term debt. It's a signal of increased risk.
And Bloomberg noted that the longer-term bonds were already feeling the pressure back when the court first heard the arguments.
They were. So if you're holding long-duration treasuries today, that 55% figure from the Tax Foundation is the only number you care about.
And beyond the fiscal damage, there's the operational nightmare for businesses.
Oh, it's a catastrophe waiting to happen. If the tariffs are struck down, you have to adjust hundreds of entries in the 4,500-page harmonized tariff schedule.
The rulebook for imports.
The rulebook. It would create a massive regulatory burden, maybe even halt imports while everyone figures it out.
And then there's all the money that companies have already paid for years. What happens to that?
That's the billion-dollar headache. Most bettors see only a 40% chance of an immediate order to return the money, but the line for potential refunds is long and messy.
Yahoo Finance mentioned Costco specifically is already suing.
A very savvy move. They're making sure they're first in line if and when those refunds are ever mandated.
Okay, with all this domestic chaos, let's shift our lens outward, because global flashpoints are feeding right back into market anxiety, starting with Greenland.
Yeah, the Greenland situation, which CNBC has been covering heavily, has escalated from just rhetoric to military consideration. President Trump is ramping up talk of bringing Greenland, which is a Danish territory, under U.S. control, and they're openly considering options, including military action.
And the response from Denmark and Greenland has been, well, pretty blunt. Open for business, but not for sale. And the Danish PM even said a U.S. takeover would mean the end of NATO.
It creates this absolute geopolitical paradox. Analysts told CNBC that a U.S. military takeover would likely be unopposed.
Unopposed. Why?
Because what European military commander is going to fire on U.S. troops? But in doing so, you render the core mutual defense promise of NATO meaningless.
So Europe's real leverage isn't military, it's economic.
Exactly. Tariffs limiting U.S. access to bases. That's their deterrent.
And the U.S. interest isn't just strategic, it's about resources.
Right, precisely. CNBC confirms the U.S. is looking at investing in Greenland mining projects. They're talking to a firm called Amaroq about gold, gallium, other critical minerals.
And the market is listening. The European Defense and Aerospace Index rallied this morning.
It did, up about 0.65%, driven by all this talk and Trump's proposed defense budget increase.
Right. Okay, let's move south. The policy shift on Venezuela. This is a huge energy story.
A very big deal. Trump announced he canceled a second wave of attacks on Venezuela.
And this was due to cooperation on rebuilding their oil and gas infrastructure, plus releasing some political prisoners.
Right, and this action is tied directly to a campaign to get prices down. WTI crude is trading around $57 a barrel right now.
But the administration wants it closer to 50.
That's what Yahoo Finance is reporting. The target is around $50 a barrel to help U.S. households, specifically with gasoline prices.
But wait a minute. The break-even price for U.S. producers in the Permian Basin is what, $62 to $64? Doesn't targeting $50 a barrel just guarantee bankruptcies in our own energy sector?
That is the essential trade-off. And the market is already seeing the pain. $50 oil is way below the break-even cost. ExxonMobil is expecting a huge hit to their Q4 results.
Between $800 million and $1.2 billion.
Yes, specifically due to these depressed prices. And it's not just the U.S. Venezuela's break-even is even higher, over $80 a barrel.
And yet, in every crisis, someone makes a fortune.
Of course. CNBC found a distressed debt investor who managed to capture 30% returns on Venezuelan bonds after the attack and sees more upside. High risk, high reward.
And just quickly on policy, there was a surprise directive on housing this week.
A big one. President Trump reportedly instructed his representatives to use Fannie Mae and Freddie Mac's capital to buy $200 billion worth of mortgage bonds.
The goal being to lower mortgage rates. But the mechanism there is a little confusing.
It's very murky. Mortgage rates usually follow long-term Treasury rates, not just mortgage bond yields. And more importantly, this kind of quantitative easing is typically the Fed's job.
Right. The executive branch can't just order the independent Fed to act.
No. So the policy is ambitious, but the execution is still legally and practically very unclear.
Let's turn to some corporate deep dives now, starting with the auto sector. The EV reset is no longer a theory. It is hitting the balance sheets hard.
The scale of the adjustment is what's really staggering. CNBC detailed how General Motors is set to record $7.1 billion in special charges for Q4 2025.
And that's $6 billion for the EV pullback and another $1 billion for restructuring in China.
And that's on top of Ford. Ford announced in December it expects to record about $19.5 billion in special charges.
Also related to slowing down its EV strategy. So combined, that's what, $26 billion in write-downs?
$26 billion. It's not just the slowdown. It's a complete re-underwriting of the entire EV thesis in a world without subsidies.
And the driver is weakening consumer demand. And the end of that $7,500 federal EV tax credit.
That's it. Automakers are adjusting huge capital plans to reflect this new unsubsidized reality.
Let's shift to the AI wars. The spending figures are just as massive, but the optimism is still there. TSMC just reinforced that.
Absolutely. TSMC, which is NVIDIA's go-to chip maker, reported Q4 revenue that topped estimates, a 20% rise year over year.
And Bloomberg and Reuters both highlighted this, right? It reinforces hopes for sustained global AI spending in 2026.
It does. It basically neutralized the traditional seasonal lull for them, which suggests AI demand is overriding normal business cycles.
But the financial commitment here it's mind-boggling. Global tech giants are collectively spending upwards of $1 trillion on data centers.
And that level of spending is exactly why you're hearing concerns about an AI bubble, the fear that capacity is being built way faster than it can actually be used.
And that feeds right into the market action we saw yesterday. Jim Cramer called it a violent rotation. The Dow was up, the Nasdaq was down.
It's investors correcting those extreme valuations. Cramer's point is that they're selling expensive tech winners to buy beaten-down stocks in more traditional sectors.
That explains why, even within the Magnificent Seven, Amazon is the best performer this year, while NVIDIA has kind of struggled.
Exactly. It's that dynamic of correcting excesses. It's healthy in the long run, but it creates a lot of choppiness right now.
Now let's look at the startup side. Elon Musk's xAI. They must be burning cash at an astonishing rate.
They are. Bloomberg reported xAI spent almost $8 billion in the first 9 months of 2025.
Wow.
It just illustrates the colossal computing costs required to even compete in this arena.
And the long-term goal is still very ambitious.
Oh, very. Building AI that eventually powers humanoid robots like Optimus. They're showing revenue growth, but the losses are massive. A negative EBITDA of $2.4 billion through September.
And we're seeing the exact same story play out in China with their big AI winner, Minimax.
Yeah, Minimax just had its IPO in Hong Kong, valued at $6.5 billion. Its CEO is now worth about $3.5 billion.
And their video generator, Haluo, is seen as a real competitor to OpenAI's Sora.
It is. But just like xAI, it's suffering massive losses from computing costs, an adjusted loss of $186 million through the first 9 months of 2025. The AI arms race is just defined by ambition and catastrophic burn rates.
Okay, finally, let's tie this back to China's broader macroeconomy, because there are some really clear deflationary pressures causing concern in Beijing.
There are. CNBC reported that China's full year 2025 consumer inflation was flat. It completely missed the official target of around 2%.
And the property crisis is still grinding on. Producer prices have been in deflation for over 3 years.
It's a very deep and sticky problem, and we saw a really significant political signal this week about it.
From the Communist Party's own journal, right?
That's right, Krixi Journal. It published a rare article calling for more powerful and precise measures to stabilize real estate. And this is significant because it argues directly against a recent view in Beijing that real estate just isn't that important anymore.
So it suggests they can't afford to let it collapse. But what does the market think?
Economists are still cautious. Macquarie, for example, still thinks new home sales will fall another 7% this year. The problem is just too complex to solve quickly.
Okay, so let's wrap this all up. As you navigate this hyper-volatile Friday, we've got uncertainty from the jobs and tariffs decisions, geopolitical shifts with Greenland and Venezuela, and this massive capital reallocation in tech and autos.
And if you connect all of this domestic political action back to corporate health, the key insight is that Washington is no longer just a regulator. It's a direct, risk-on investor in U.S. tech. CNBC reported the U.S. government is now Intel's biggest shareholder, a 10% stake valued at over $18 billion.
Some investment last August.
Right, and that juxtaposition is fascinating. The government is a major tech investor, while at the same time creating regulatory chaos with tariffs and EV tax credit cuts that directly affect its own investments.
So the future performance of a bellwether like Intel now depends directly on the success of a political bet.
That's it. It's the ultimate symbol of how interconnected Washington and Wall Street have truly become. Something to watch very closely.
Thank you for diving deep with us today. We'll see you all Monday morning with new headlines from major financial magazines.